enable.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
If you are searching for ways to make your money work hard for you, then you've arrived at your destination. Welcome to the Mutual Fund Day Family Financial Plan series here on CNBC TV 18. Each episode gets you a ringside view of unique journeys of financial planning with case studies of couples from different financial backgrounds based across India. The idea is to learn from diverse experiences in growing wealth. So let's get the money ball rolling with a profile of our latest couple, Narayan and Chetna from Mumbai.
On this episode of Mutual Fund Day Family Financial Plan series, we bring you the financial case study of telecom marketing professional from Mumbai, Mr. Narayan Jaisingh. He lives with his spouse Chetna Jaisingh, who works as a travel consultant, and parents Govindram and Lata Jaisingh.
So, like any traditional Indian family, I was born and brought up in a house where primarily fixed deposits and PPF and real estate was the asset classes that were into consideration. Equity was practically nil or was not considered as an area to be ventured into. So almost till the age of 25, 26. I started working at 22. Almost at the age of 25, 26, I was rigorously into fixed deposits and PPF. And that's when I realized that, I wanted to experiment and go beyond these two standard asset classes because I was not very open-minded towards real estate. And then in due course of time, when I started studying overall of the economy, and I realized that, what is the stock market? Why is that we are kept away from it? And how do we learn about it if the world is revolving around stock markets? Came across this concept, mutual funds, read about it, researched about it, met a few biggies, industry stalwarts where I understood that, fine, how does it work? Started in a small fashion of 10,000 systematic investment plan, and I'm glad that now practically 70% of my portfolio is in equities. Probably I would be the few lucky ones where I have not really lost money in mutual fund. I've only made money.
Mr. Jaisingh's investments include equity, mutual funds and PPF. He started investing in equities 2007 onwards. PPF and fixed deposit investments were initiated in 2002. Chetna started fixed deposit investments in 2007 and equity investments in 2010. They save 52% of their incomes, 89% of which is allocated to equities and mutual funds and 11% to debt.
I'm not a very real estate person, so I'm not quite keen on the real estate. But two things. I want to have a retirement plan in place, plus house for self-consumption pattern in the next 5 years and between the suburb locations of Bombay. And I'm looking at a retirement corpus. So these are the two imminent goals that I have, which I know are very big ticket items. The rest is day-to-day, which can be managed. The short-term part, as of now, the emergency fund, which is kept aside, is largely for family purposes. The next I'm looking at about 5 lakhs, which is in the next 3 months, if I would say, which is for the international holiday. That was the one. And the next year, mid-Diwali, as in next Diwali, so we've got about 15 months in hand, 15 to 16 months, looking at redoing the house completely with the interior. So that is a tentative quote, about 20 lakhs is what my immediate short-term goal would be.
Narayan and Chetna aim at building a corpus for their long-term goal of purchasing a property for self-consumption. They aim to achieve their goals with structured fiscal planning and assistance from a financial planner.
Right, that's the financial resume of our featured couple for this episode. Let's take a short break at this point. We will return for an in-depth conversation with Narayan and Chetna to understand their financial planning journey. Also joining us is Pankaj Matpal, an independent financial planner, for insights on managing money the right way. Stay tuned.
The mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Welcome back to the Mutual Fund Day Family Financial Plan series. For viewers who are just tuning in, we are talking about fiscal fitness for gaining financial muscle with our guests today, Narayan and Chetna from Mumbai and Pankaj Matpal, who is an expert in managing money. Now, in the previous segment, we got a broad look at the financial goals of the couple. Let's focus on the fine print now. Thank you so much for joining us. Narayan, let's start with you. Why don't you start by outlining your asset allocation and the goals and see if it's in sync with that?
When I started my career, I was born in a traditional household where debt was more recommended over equities. So I started with the family tradition, and I was more on the debt side. When I started working in my workplace, and plus the euphoria of stock markets in the 2006, 2007, I was wanting to enter it and study about it. That's when I researched about mutual funds, took a small step in the form of SIP. And as we stand today, my 60% of the portfolio is in equities versus 40% in debt right now, where 10 years back, it was 100% debt. And now I've managed to flip the ratio, where I'm just 40% in debt and 60% in equity.
All right. Pankaj, what's your prognosis of Narayan's portfolio?
See, when you do financial planning, most important thing is first contingency planning, then coming to your goals, short term, medium term or long term, and then retirement planning. So for contingency planning, Narayan has kept money in saving bank account. See, mutual fund is not only the equity. There are different kinds of fund, and liquid fund is one category of mutual fund. And recently SEBI has allowed immediate redemption in liquid funds. 90% of the corpus can be redeemed, or 50,000, whichever is less. So it makes better sense to park your money for contingency in liquid funds. So in case of emergency, anytime you want to redeem, you can redeem it online through your mobile app or online. So that, because if you park your money in saving bank account, you know that interest is very negligible. So compared to that, because you never know, the money may be lying for a long term also if emergency does not come. So you're losing opportunity to earn interest on that, to earn returns on that. So I'll advise that Narayan should keep his money in liquid funds, because he's missing in his portfolio. He does not have any liquid fund as of now. So when you're planning something which is coming after 6 months, 1 year, you can have some money in fixed deposit, but still debt funds are missing in your portfolio. It's not only that goal which is coming after 1.5 years, after 6 months. For your goals which will be after 5 years, for example, like you want to buy a house. So for buying a house also, along with equity, you should have some component in debt funds or balance funds. So two things what I'll advise. One is immediately you should include liquid funds in your portfolio for emergency. Second thing, some allocation should be in debt funds. And if you see from the tax efficiency, these debt funds are more tax efficient compared to your fixed deposit.
Okay, so that's your prognosis of his portfolio. Chetna, your journey into equity started in 2010, I believe. What was the trigger for that?
My dad is into this business, into equities, so I also joined him, and I also do, being Narayan in my life. So he's been helping me, my dad's been helping me, so 90% have been positive.
All right, okay. Talking about starting points, Pankaj, what's a good starting point to enter, say, the mutual fund space for investors? Are ultra short-term funds a good starting point for new mutual fund investors versus, say, hybrid funds or balanced funds?
Yeah, definitely. See, once you set your goal and you know that you're investing in different goals, accordingly you can choose the funds based on your objective investment, risk appetite, time horizon. But yes, as a new investor, because they are a bit more cautious about their risk appetite, so I'll say that they can start with the balanced fund if the time horizon is a bit longer, 4 or 5 years and above. And otherwise, liquid fund, at least everybody, when he joins a job, he gets his salary, he starts any business. So liquid fund is something that he should immediately park their money. And when they compare with the saving bank account, definitely they will realize after some time that they have earned a little bit more than that. And once in the liquid fund itself, if they have some corpus, then they can switch it to some equity funds after they understand the mutual fund and equity market. They can switch to some better performing funds. So that is one. Second thing, as soon as you join a job, you get salary, you plan for your tax savings. So ELSS is one category in mutual fund. I think that everybody, before PPF rather, I will say that they should think about ELSS. Because when you start investing in PPF, then also you have a target of 15 years. So why not in ELSS then? See, people, when they invest in PPF, they think about long term. When they invest in equity, they think about the short term, which should be other way around actually. Because in ELSS, the lock-in period is only 3 years. So they think that in 3 years, but it does not mean that you have to redeem your money after 3 years. It's the minimum lock-in period. So I'll say that whenever you join job, start SIP in ELSS, do not think from the 3 years perspective. You will save tax, and this will help you building retirement corpus.
All right. Before we wrap up the segment, Narayan, what's your emergency fund allocation?
Right now, it's 100% saving account.
Okay.
So I've kept it in the form of cash.
Okay.
That, so that if I need it, put a debit card and take it out. That's conventional mindset that, okay, it's easy liquidity, it's easy access.
And any plans to change that strategy, or do you plan to continue with that strategy for
No,
some time
definitely. I plan to move it to liquid funds now, since we've discussed this. So I think, yes, it does make better sense. And as I said, the emergency fund, I'm not sure on the requirement, but it's just kept aside. So why not keep it in liquid funds when there are ways to get it liquidated faster?
All right. Well, it's time for a quick break on the show. Stay tuned for the Mutual Fund Day Family Financial Plan series as we reveal more insights into money management for you. Stay tuned.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
We are back on your screens for the final segment of the Mutual Fund Day Family Financial Plan series, a show that's all about making your money work for you. Let's pick up where we left off with our guests. Pankaj, starting with you, how do you gauge the quality of a fund? Just for our viewers, what do you think should be the key parameters that they should look for?
First is consistency in the performance. You should see that when you are selecting any fund, how consistent it is. Not that 1 year it has performed very good and another year it was not so well. So better that consistency is more important. Second thing is not only returns, you have to say risk as well. Though for a new investor it will be difficult to see that risk parameters, but one should understand that that it should not be that fund manager has taken very high risk to deliver better returns.
Okay.
With the minimum risk, if returns are better, that's the wisdom of fund manager. Okay. So that is why you should compare funds with the benchmark, and any fund which has not been able to beat its benchmark, that should be avoided ideally if consistently it is not beating the benchmark itself. And the fund house also you should see that how stable that is and how the fund manager is performing. And sometimes that we see a fund is being managed or fund managers are being changed very frequently. So those things at least you should see. For a new investor, at least those things are important.
Narayan, I noticed you've not made a real estate investment. Is that a financial goal coming up in the horizon? And how do you plan to kind of tweak your portfolio to achieve that financial goal?
Yes, real estate is planned for the next 5 years. Looking forward for a house for self-consumption. And we've tweaked the portfolio where we'll be putting more into aggressive funds to meet that kind of a requirement in the next 5 years. Looking at about a 2.5 crore kind of a value of the house considering today's inflation. Current market price plus factoring inflation for the next 5 years. So that kind of tweaking has been made in the portfolio.
Okay. Chetna, any additional goals to add which might be coming up on the horizon?
Yes, we're looking for an international holiday in the next 6 months.
In the next 6 months.
And then we're looking to redo our house.
Okay.
So that's in another 8 months, 8 to 10 months. So we'll be redoing our house.
Okay. So looking at all these goals on the horizon, is there some sort of a tweaking coming up for their portfolio? Do you recommend?
No, they have sufficient investment in fixed deposits. So for short-term goals, they will use that money. But what I found that they are missing mid-cap funds in their portfolio. And I'll advise that they should have allocation. First thing that they should allocate some money in mid-cap from their large cap. Their SIP also going mostly in multi-cap or large cap, but because their goals are long-term goals as a retirement especially. For this, I'll say that allocation should increase in mid-cap. That is thing. And their SIP also, you should increase your SIP because considering your household expenses as of now and factoring in inflation, you will need a big corpus for retirement. And for that, it is better that you increase your SIP. If not immediately, what strategy you should make at least 10% every year because your salaries are also increasing year after year. So whatever amount of SIP you're doing now, every year make a point at the beginning of the year. By 10% keep increasing, 10, 8, whatever possible comfortably. But because you have to build a big corpus for retirement, life expectancies have gone very high. People earlier 60 years they were retiring and living for 10, 15, 20 years. But now people live till 90 or 100 years. And as the medical science will progress, the life expectancy will go higher and higher. So considering that fact, you should have sufficient corpus for retirement. So my advice to every investor, whether you can take high risk, low risk, but some part of your portfolio should be allocated in equity, which will help you beating inflation.
All right. Pankaj, with markets at all-time highs, what do you think are the mistakes that mutual fund investors should avoid?
See, continue your investment. If you have never invested, start investing. Don't wait market to correct. Every time is good time. And if a time horizon is good enough, if not directly, you are not going in equity, at least start with the balance fund, or there are some funds based on asset allocation, dynamic funds, where equity allocation can be less or more depending on the market. That kind of funds you should include in a portfolio, and start through SIP or STP. Means instead of investing a large sum in lump sum, it is better to invest in staggered manner. So at least if there is a correction in the market, you will get advantage of that. So start investing, set your goals, and based on the goal, whether debt funds, hybrid funds, large cap funds, mid cap funds, but start investing. That is most important.
All right. And speaking of caveats, how do you address the perception of insurance as an investment vehicle? Because there is this myth of insurance as an investment vehicle. How do you address that myth?
See, insurance and investment two are different things. When somebody is financially dependent on you, you must have insurance. But for that pure term insurance, which is known as term insurance, that only serves the purpose. Because if you're buying an insurance policy with some assured of 5 lakh, 10 lakh rupees, and God forbid something happens, then I don't know how long that money will last. So if you're thinking about insurance, then based on your need, it should be something like larger amount, 50 lakh, 1 crore or whatever. You feel that your family can survive with that money. So term plan only serve that purpose. And for investment, you buy investment products. Combining together will neither serve the purpose of insurance nor investment.
Right. Narayan, do you have insurance in your portfolio?
Yes, I've got a term insurance for 1 crore.
Okay. All right. Let's move on to retirement corpus. We were speaking about that earlier. Narayan, what are your retirement corpus plans? Have you started planning on that front and, say, started to front load investments on that front so that the more you put your money into your retirement fund, the less you have to work as hard as that later on? So do you have your plans in place for your retirement corpus?
Yes, we've discussed those plans, and those plans are, we form those action items. It's just about starting and converting more money in those.
Could you share more details on what's your retirement goal, and what's the sort of money that you're trying to target for your retirement fund?
So retirement, I'm looking out for the next 25 to 30 years, approximately. That is the retirement age, apart from the corporate retirement age. So factoring inflation, we're looking at about a huge corpus, about 15 to 20 crores, factoring current inflation for the next 25 to 30 years. So accordingly, instruments have to be tweaked. Accordingly, the SIPs have to be increased. So all those discussions and all those plans, mathematical algorithms are in place. It's just about starting to convert money in that.
Okay. Pankaj, could you suggest some do's and don'ts for our viewers in terms of retirement corpus planning? What would you list as the top 3 points that they should look at?
Yeah. First thing, as you said, the 15-20 crore, I'll say that considering your current household expenses, you will not need that much money if you can really build the corpus of 15-20 crore, nothing like that. But I think that if you want to enjoy the same lifestyle as of today, still with a lesser amount also it is okay. So, but at least your target should be 10 CR if you want to live that kind of life, and you want. I expect that after retirement he would like to go on more vacations, as now also you do. First thing, that you have been investing, that is good. Increase your allocation in mid-cap funds little. Increase your SIP amount, as I suggested you earlier as well. Continue this, but when you are close to your retirement goal, when you are about to achieve your goal, at least before 5 years, start reducing your exposure in equity and increase in debt, which will make your portfolio more stable. So initial years, invest more in equity, less in debt. When you are close to your goal, that time every year in staggered manner you start allocating more in debt. After you are retired, when you think that now there is no more money to invest and the money should be preserved and should also increase, that time your equity allocation will be much lesser and more will be in debt debt funds or that time debt instrument, whatever it is. That is important. Second thing to you as well as to other investor, I will say, whenever market goes down, people become fearful and they stop SIPs. Actually, that is the best time to increase SIP, but at least if you cannot increase it, don't stop it. Okay. SIPs are meant for that, because in the volatile market only you'll get the benefit of, if the market is only going up, it would have been better that you invest a lump sum amount. So if you are investing through SIP, it is better you continue, and if possible, whenever market goes down, if your it is possible for you to invest more, try to add some more. Top up to that existing SIPs will help you creating wealth and achieving your goal faster.
All right, time for a summary statement now from the couple. What are the lessons that you two have learned from your investment journey? Narayan?
As Pankaj rightly said, start somewhere, start soon, possible. Don't be fearful of the volatility. Have faith in your instruments that you've chosen, especially the funds that you've chosen. If possible, and that's exactly what I did when the markets were low in 2014 during the NDA elections and the budget last year, when it was at 22-23, I practically doubled my SIPs, and I'm reaping the benefits now if I check on the weighted average basis. I guess that's the most important message I would say, that don't wait like me for 5 years after starting career. Start from the day one, from the first day of your career.
All right, Chetna, any words from you?
Same here. Start investing and don't stop SIP when the market is low. In fact, invest more.
All right. On that note, we'll conclude this episode of the Mutual Fund Day Family Financial Plan series. Thank you to our guests for sharing their points of view. And of course, thanks to our viewers for tuning in. We will be back with a brand new journey of financial planning for the next show. Keep watching CNBC TV 18.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Focus. Ideate. Innovate. Enable.